10/18/2012, we have the VIX Market Volatility Index, called the CBOE. It's a fear indicator that will go along with the S&P 500. When fear indicators go higher, more people are selling. One of the things that we know here, that there's still, even with the correction that we've had across the board here in the Dow over 1,000 points, and we're in bear territory in the Nasdaq Composite and whatnot, the S&P remains up here at 1359 area. The way that we view this at the current level is to put a bottom in a market. The last time that we had a correction, the fear indicator broke up here to around 27. We can clearly see that the bottom lower end of that trend line is we go up, and this is how you measure the volatility. One of the things that we're mindful of here is to put a bottom in a market, you need to spike higher here in fear. When this go higher, markets go down. Now we know that we have the fiscal clip, and we're going to be looking at directly what this will do and how this daily base has set itself up for higher highs. From the current level, when we take a look at the daily simple moving averages, we can clearly see that the 10, the 20, the 200, which is the green line, the 100-day simple moving average, the 200-day, is that we're finally getting support at higher levels. Now, one thing that we've noticed over the last couple of years, that this particular fear indicator lags a lot more than it ever has in any other time in history. So basically, as we set things up, as we have here, we have a lower base. When markets sell off, this went straight up. When markets started to rally, it came right back down into the base. And then you can see the choppiness of it because they run invert. When this goes down in value, then markets will go up in value. If we shoot up here in that VIX, and people can buy VIX calls and stuff like that to manage the risk in their portfolio. You want to have that particular type of trade here using the options, Market Volatility Index, CBOE, is that if we believe that this is going to go higher, then we take a look up and out of the money, like a $20 call. Okay? Right now, the way that we see it is that the December contracts are going to be the ones to look at. Therefore, when we take a look at the strike prices, if the VIX goes higher than if you buy calls on the VIX, that's how people hedge their portfolio. Now, we'll be taking a look at various different strike prices. We are relatively low in this reading, even though that we've had the correction. When we had huge spikes up here in the past, as I can go back into history, 2010, when fear was rising, markets were selling off, and when the markets put the bottom in, this put the high in. So a lot of people haven't really paid attention to it. The thing about it is, in 2011, we were way up here almost at 50. And that's when the markets put their bottoms in 1 year ago in the volatility index. Therefore, the 2011 highs is when we put in the bottoms in December of 2011. Now we're right back over here again at historical lows in the volatility index. What we will be looking at is up and out of the money calls. Here is the 2012 peak, like I said, right here at around 27.21, and then we got right back down. Now, when this is very low, what the real technical readings mean is that people are complacent and there isn't that much fear, or there isn't that much concern in the marketplace. Well, I can tell you with the fiscal cliff around the corner, with the Thanksgiving holiday, if we start to break higher, markets will continue to sell lower. And once again, the VIX is related to the S&P 500 index. They run invert of each other. If the S&P is breaking out, then this is going to come down. However, we are building a base here. We're going to be watching what this base up here is compared to this lower support level, and what Monday, Tuesday, and Wednesday will bring. It'll be a light trading day week. However, I will tell everyone that if they don't get their act together, what will end up happening is, and this thing is at its lows now, and it's in complacent territory still. So we're not seeing any huge fear yet. However, if we start to sell harder in that S&P, this fear indicator will go higher. This is the update on the VIX Market Volatility Index CVOE, which is a fear indicator to the S&P 500. It's building a daily base. It's in a range. And once this thing breaks out, markets would go higher. If we come back down into the lower area, then markets will have a relief rally. It is that time of year to be very mindful of where this fear indicator is going into the Thanksgiving holiday and Christmas holiday.